Hello everybody and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is William Rhind, Managing Director at the World Gold Council. William, thank you very much for being on the show.
You're welcome, Mike. Thank you.
Now I know you're at the Gold Council. I know you focus on institutional investing trends over there, institutional investors. Why don't we start off in that area? Let's first define that. I would assume you're talking about large pension funds, endowments, sovereign wealth, right?
That's right, and I would say also hedge funds, asset managers, money managers, sort of more broadly defined.
Now, clearly we've seen interest on the part of institutions really ramp up, I would say starting back probably in 2009, 10, 11. As a matter of fact, I can recall in 2011 like a rush to get in, but that was kind of like almost a market peak at that time, a price peak. How is the interest now? Would you characterize it as still a strong, steady interest? Are they price sensitive, or is it really just now, hey, this is an asset class we want to own and we're going to put 3% or 5% and we're not really price sensitive?
I think it's more of the latter. So people now looking at gold as a longer term, evergreen investment that represents 5% of your portfolio. But you're absolutely right. A few years ago, there were a lot of big names, famous names that came into the gold trade, really, I think, chasing momentum amongst other things. And that largely went away last year as the gold price came down. So I think we've sort of stabilized in terms of our investor base, specifically when we're talking about gold ETFs. And we're starting to see some inflows again this year as the gold price has traded up rather nicely year to date.
Right. Now, what happened to sort of crystallize this idea, that gold is it's always been, I think it's always been an asset class. Look, I've been involved in the commodity markets for 30 years. I remember making this pitch in the early 80s about you got to diversify commodities, but something happened. It was recently in the 2000s when people and institutions started to really buy into this idea that, hey, we have to own gold in earnest.
I think the financial crisis was clearly a big catalyst to that. So as you know, gold was one of the best performing asset classes in 2008 and returned a positive return for that year when equity markets were down significantly. And I think that sort of crystallized in a lot of people's minds what gold could do in a severe stress situation in equity markets. And I think after that, you therefore had continuing fears over the global economy, which caused more people to buy gold. But then you had also this reaction to the monetary policy here in the US and Europe, which as money was printed, investors feared that would lead to rampant inflation, and therefore bought gold fairly aggressively after the crisis.
But that didn't happen. Is that sort of surprising to some people, you think?
I think it was surprising to some people, and I think those that expected that to happen sooner than 2014, maybe some of those people exited gold in the last couple of years. But there are a core of investors that still very much view gold as a hedge against inflation. And of course, while we don't have that situation right now in the economy, potentially in the future, if that was ever to arise, then that's why some of these people hold gold.
Now, certainly I would think the advent of some of these exchange-traded funds like the GLD has been also a catalyst bringing people into these markets. It's created a way to pretty easily get exposure to gold, correct?
Correct. So, very simply, if you're an investor of any type and you have a portfolio of securities, rather than just having equities, bonds, or mutual funds, you're now able to buy gold in just the same way as you would any other stock. And so, I think that helped in terms of ease of access significantly, and therefore an equity investor that has a portfolio could buy gold just as easily as buying shares in GM or Apple. So that certainly helped people get exposure, and it's become a hugely popular way for people to invest in gold.
Yeah, no, clearly, and I could totally understand it with respect to smaller investors. But
Yeah.
let me ask you again from the institutional angle, and institutions, because of their size and because of maybe their relationships with very sophisticated Wall Street firms, they probably have a range of ways that they can invest in gold. How do you see it in terms of, you know, the way they're going about it? Are they doing the GLD? Are they doing physical bullion? How do you see it? Shares, gold shares?
So there are a number of different examples. I think, you know, commonly we do see some large institutions investing in GLD. You know, they physically back gold ETF. And the reason for that is actually not too dissimilar from an individual investor or a financial advisor, in that they manage a portfolio of securities.
Right.
And if you want exposure to gold, then GLD is a security that's backed by gold, and therefore it's a natural fit with the portfolio. There are some other regulatory reasons, sometimes, doesn't apply to all funds of course, that mean that they can't actually own the physical bullion itself. They have to own it in security form. But there are, you know, one or two examples, I believe, of larger pension funds and endowments that have gone and bought the physical bullion. And of course there are, you know, many pensions and endowments, probably most of them, that invest in mining shares by default, by having exposure to, you know, the broader equity market.
Now, we've also seen in the past couple of years a resurgence of interest on the part of central banks. And I know that back in the 90s, central banks were mostly sellers of gold. I've often looked at them as great contrarian indicators, but I mean, they're kind of back in. We saw, you know, we see China, you know, official purchases of gold, Russia, India, that sort of thing. What's behind that, do you think?
I would say that it's not so much a case of they're back in. I would say it's a different group of central banks that are, you know, stimulating the activity. So whereas we had selling from some of the, you know, larger Western European banks in the past, you know, not exclusively, but now the trend is more net purchases of gold, but are driven by the emerging market central banks. And the reason why they're doing that is because they're accumulating large foreign currency reserves, typically those are dollars,
right?
As their, you know, export economies attract your dollar and foreign currency reserves, and they simply need a way to diversify those currency reserves. And in some respects, they're not too dissimilar than any other investor that's looking to gold as a way to diversify exposure to, you know, broader asset class.
It's kind of like a short-term treasury, but I guess without that, necessarily without that direct dollar exposure when they do it that way.
Yeah, and I think the important thing is, like you say, that they're already exposed to the dollar. They have a lot of treasuries,
right.
They have a lot of dollars, and therefore they need something that is a diversifier to the dollar. And gold, of course, historically, you know, has been one of the ways to diversify exposure to the dollar.
Now, on that point of, you know, historical diversification, let's say historical return, actually, if you look at the return on gold from the prior peak in 1980 when it hit 850, adjusted for inflation, it really hasn't outperformed. So how do you make a strong case that it's an inflation hedge when I think the price needs to be something like 2,500 an ounce to surpass that prior peak on an inflation adjusted basis?
Well, I think from an inflation perspective, inflation is quite an abstract construct, because typically when people talk about gold being a hedge against inflation, they're tying it to some benchmark, and a benchmark is just a measurement. You know, we think of inflation more in terms of purchasing power and being a global phenomenon rather than just a US specific phenomenon. So in an environment where, you know, official CPI tends to be, you know, higher than average, and typically that's probably something in the region of, you know, 4% plus, then gold has shown to have a high correlation to inflation. But more of, we think about it, it's a purchasing power and a way to maintain purchasing power against the depreciation of fiat currencies.
Right. You know, I heard something interesting recently that historically countries like India, you know, they were large consumers of gold, investors. It was something that they, you know, believed strongly in, but as their economies modernize and their monetary systems, you know, there's a little bit starting to veer away from that, but yet a country like the United States, which has, for a long time been very sophisticated in terms of our financial markets, there's more interest now developing in gold because they really see that as a kind of an alternative asset. Is that right?
I would say that in terms of the U.S., of course, American citizens only were able to start buying gold in the early 70s. So we haven't had a long track record of
That's true too.
Citizens being able to freely buy gold. Within 40 years, effectively, of time when people can buy gold. So I think the market is still quite young here, if we can say that. Whereas in some of these other countries, citizens have been able to buy gold for a long, long time, and therefore there's a much higher cultural attachment and much more of a cultural significance to gold than perhaps here. But certainly, the trend, as we've seen certainly over the last decade, less so the last 40 years, but over the last decade, as people are starting, I think, to embrace gold more and start to really think about the value that gold can add to a portfolio.
So it does sound like this is not a flash in the pan or a fad. I mean, this is basically a sea change in the perception on the part of investors, both large and small, and we should expect that to be, the feature of the gold market going forward, correct?
Gold has been around for 5,000 years, and there's no reason to believe it won't be around for the next 5,000 years.
Every ounce of gold ever mined is still here, right? It's
That's
not
right.
like we burn it and it goes away.
Yeah, and while certainly we see investment appetite here in the US and in Europe, we mustn't forget that the largest force driving the gold market from a demand perspective is still China and India,
Right.
and Asian countries more generally. So there's still very strong demand that we see out of the East, and in many ways some of that gold is moving from west to east as consumers look to diversify their wealth and utilize gold store of value features.
All right, long term sounds very bullish to me. William Rhind, thank you very much.
Thank you, Mike.
That's it for now, folks. This is Mike Norman saying, see you next time. Bye-bye.